I guess we'd have to start immediately, so that we can close as early as possible today. So yesterday we started solving questions on IAS 16 PPE. We started with this question where we're able to determine the initial costs of an item of PPE. Then we solved some questions on how to calculate depreciation, like two questions. Then we wanted to start this, and we could not because of time. And so we're going to continue that today. And I gave you as assignment. Yeah, there was somebody that did it and got it all right. And few of you also attempted it, but most of you did not do it. I mean, you can do better. So, um, where is Femi? Femi is not in class.
I'm in class, sir. Good evening, sir.
Hi, Femi, how are you?
Yes, I'm fine, sir. Thank you.
Are we ready for today?
Yeah, I'm with you, sir.
All right, so let's quickly go over the question again,
Okay,
then quickly solve it.
okay, sir. Noodle Nigeria Limited (NNL) manufactures various types of noodles in Oluyole for sales across the state in Nigeria. Recently, to continue to sustain leadership of the company in the Nigerian market, on September 1st, 2015, a brand new machine was bought from a supplier under the following conditions. Supplier's invoice price, that is 500,000. There is trade discount applicable to invoice price, 25%.
Okay,
There is this.
all figures assumed correct. So
Okay, sir.
let's start from on 1st of September.
Now, on September 1st, 2016, NLL Limited decided to upgrade the machine by adding new major components at a cost of 300 million. As a result of the new upgrade, there was an increase in the remaining useful life of the output to 8 million units on September 1st, 2016, and the residual value of the machine was revised to 114,000. I mean 14 million, sorry. You are required to describe what is meant by depreciable amount within the context of IAS 16 on property, land, and equipment, PPE. That's one mark. B, highlight three characteristics of depreciable assets under IAS 16. That's for 3 mark. Describe the two model of accounting for cost of property, plant, and equipment, PPE, under IAS 16. That's for 3 mark. D, calculate the following. 1, machine costs for 3 mark. 2, revenue expenditure over the year in the state of profit or loss. That's for 5 mark. The third one is carrying amount of the machine over the years. That's for 5 mark. Total mark is for 20 mark. Thank you, sir.
Thank you very much, Femi. So this was a past question, and I mean, this is a good question to answer, to be candid, because there are a lot of freebies for you. Like where they ask you to describe what is meant by depreciable amount, and they give you 1 mark there. So depreciable amount is just the cost minus residual value. That's you get 1 mark for that. They also said you should highlight three characteristics of a depreciable asset. And number one, a depreciable asset would have a limited useful life. That's number one. A depreciable asset must be capable of generating future economic benefits. A depreciable asset must either be held for production or supply of goods or services sent out to others, or for administrative purposes. So that would basically earn you your 3 marks. They also ask you to describe two models for accounting for PPE. So we have the cost model which is cost minus accumulated depreciation minus impairment, accumulated impairment losses, while the valuation model is the fair value or revalued amount minus subsequent accumulated depreciation minus accumulated impairment losses. That will also give you 3 marks. So easily you can get 7 marks. Then we now ask to calculate machine costs. This is similar to initial cost. So that's when you will really need the question. So the D parts is asking for the determination of machine costs. Machine costs. So looking at this question, this company, they manufacture various types of noodles in Oluyole for sale across Nigeria. So they said recently, in order to continue to sustain leadership of the company in the Nigerian market on September 1st, 2015, they decided to buy a machine on 1st of September. And these were the costs, like under the following conditions. So with this information now, with these items here, we can easily answer that 3 marks. So let's run through it together. Let's start looking at it together. The first one, which is the supplier's invoice price. Is that going to be part of the machine cost? Yes or no?
Yes.
Yes.
Okay. So supplier invoice price, 500,000. The second one, trade discounts, 25%. That's
Yes, it will
25%.
be part of the investment.
Okay, so that's trade discounts. So what's 25% of 500,000?
That's 125,000.
Okay, are we adding this one too?
Yeah, we're going to add it to the
Yes, sir.
invoice price.
Okay, clap for yourself.
We will subtract it from the invoice
No,
price.
so we will subtract it.
Okay, all right, we'll subtract it because they discount. The next one is discount applicable on invoice price for early settlement discount. What do we do with this?
It will not be capitalized.
It will not be part of them.
That's good. That's good because this one is a cash discount. Abi?
Yes, sir.
Yes,
Okay. What about freight and shipment cost?
It will be
it will
capitalized.
be part of the cost.
Okay. Freight and shipment costs added. What about dividend expenses?
It will be capitalized.
You're so confident. What's dividend expenses?
So what's the meaning of TV though?
Is
That's what
those
I'm
people
asking.
that work? That's those people that work in a shipyard that offload or arrange things in the ship. They work in the shipyard, dockers, or they call them dockers or something like that.
Okay, that's correct. So when you import goods and they would help you offload your goods and all of that. So that's correct. So dividend expenses is part of the directly attributable costs. It's part of handling costs, something like that. What about initial operating losses?
It will not be
It will not be
capitalized.
part of the cost.
Good. What about handling costs?
Yes,
Okay. What about electrical and installation costs?
It will be part of the initial cost.
yes, it will be part of the cost.
Okay. What about interest on loan at the point of usage?
Yes, sir.
It will be part of the cost.
It will be added to the cost.
What about interest on loan after usage?
No,
No,
it will not be
it will not
part
be
of the
part.
cost.
Okay, I'm curious. Why is this one part of it?
Interest on loan.
It's not going to be part of it, right? And the only reason is because this asset is not a qualifying asset. this asset is an asset that is already ready.
Oh,
Yeah, is not a qualifying asset. It's not an asset that we construct ourselves. It's only an asset that we construct ourselves, that we capitalize the interest that is incurred to, like, on the borrowing to construct the asset, like we did in the last question we solved. So because this asset is already ready, any money we must have borrowed to buy the assets, the interest we are paying on it is expensed. So you see this interest on loan to the point of usage, interest on loan after usage, expensed. They are not capitalized.
okay.
Now, what about pre-operational expenses?
It will not be capitalized.
Exactly.
To
So
be expensed.
any pre-production cost, startup cost, pre-operational, they are all expensed. What about staff training in the use of the machine?
It will not be
To
capitalized.
be expensed.
Thank you. What about professional and consultancy fee?
It will be
It will
capitalized.
be capitalized.
That's correct. This will be capitalized. What's the next one? Purchase of a 4-year contract?
It will not be
It will not be
capitalized.
capitalized.
That's correct. So rather, we expense it over 4 years, Abi?
Yes.
But it's a 4 years maintenance contract. What about pre-production testing cost?
To be
It will be
capitalized.
capitalized.
That's correct. Should be capitalized. And I think that is all. Residual value, no. Okay. So can you sum this? Remember to deduct this 125. Okay, so let's move to the next part of the question. So this you will get 3 marks immediately. So the next part says that revenue expenditure over the 3 years in the statement of profit or loss for 5 marks. So you see, this revenue expenditure first would are basically those items that we did not capitalize. These items should be expensed. These items should be expensed. Now, but if you look at this question, they said over the years. So it's not just about the first year, it's about the remaining part of the years. And from this question, we know that we bought these assets at the beginning of the year on September 2015. The only way I know that this September 2015 is the beginning of the year, because if I read further into this part of the question, I can see that they give me year end as August, and the first year end year is August 2016, which means that the beginning of the year would obviously be September 2015. That's what we end here. Okay. So knowing that these are the year ends given to me in the question, so the question wants us to determine the revenue expenditure over those periods from August 2016, August 2017, August 2018, August 2019. Okay. And let's put our naira, our currency units. Okay, so let's go again. Which items did we not capitalize? Of course, we did not capitalize this discount. So can we attribute this discount as revenue expenditure? Anybody? Can we attribute this discount as revenue expenditure? No, of course we cannot, because this discount is an income. When we get it, it will be like a discount received. So it's not a revenue expense, it's not an expense. The ones that would be expense in the first year We would have initial operating losses. Yeah, so let me just bring it back here. Initial operating losses. I would have these two interests. Interests on loan to the point of usage and after the point of usage. Let me bring the two of them back here. Just interest on loan is interest on loan. Okay. So then we have pre-operational expenses that would also be capitalized, expensed. Pre-operational expense. Also, we have staff training, which should also be expensed. So, our staff training in the use of the machine. Also, this maintenance contracts, you see that is 120,000 and is a 4 years maintenance contract. So let me just call it maintenance. So since it's 120, so we'll spread it over 4 years. That's 30 in year 1, 30 in year 2, 30 in year 3, 30 in year 4. That's how we're going to spread it, the maintenance contract. And that's all. That's all. So I've recognized all my revenue expenditure. But you know what? There is one more thing that we have not recognized here. Can any one of you figure that out? That should be expensed from the end of year 1 to the end of year 4. Can anyone figure that out? Okay.
Depreciation.
Thank you, Joy. Depreciation. Depreciation, yes, because these initial costs has to be depreciated per annum. Okay, so since we have not solved that, so that means we cannot complete this part until we conclude this third part that asks us for carrying amount of the machine over the years. So let's do that because that is what will help us determine our depreciation. So let's get the carrying amount. Now, to get carrying amount, I need cost, I need accumulated depreciation. To get accumulated depreciation, that will be cost minus residual value divided by useful life. They might not give you useful life, they can give you depreciation rate. The examiner can decide not to even give you depreciation rate and give you units. Units. I told you useful life can also be expressed in units. And this question gave us useful life in units. And the examiner was very specific about that. He said estimated useful life in machine output or units. And he said it's 5 million. And I already taught you in this class, in my first class, on how to, my second class really, on how to allocate the depreciable amount where you are given units. And I feel that if you add this together, can you please add this together? Because these 5 million units, that's what they spread in each of these years. If you add this together, is it going to give you 5 million? This 2.2, this 3.6, 4.4.
It's 5
Okay.
million.
Okay, so it's not giving us 5 million. It's giving us 4.6 million or 4.4. What is it giving us?
4.4.
4.4. Okay, good. So what's happening here is that means the asset can even still go extra 1 year. And we believe that extra 1 year, then it will exhaust the remaining 600 units. Okay. That's just the interpretation, but it doesn't affect anything anyways. Okay. So how do we deal with that? Very straightforward. Let's let's do this calculation of carrying amount. Okay, so again, I'll have August 2016. My currency. Now, based on what I have here, what was the cost of these assets? The cost of these assets here is 578,000, right? Yes, 578,000. What's the residual value of these assets given to us? The examiner gave me estimated residual value to be how much?
90,000.
90,000.
Okay, 90,000. Now, I would remove my residual value from my costs so I can get my depreciable amount. Can you give me my depreciable amount?
488,000.
488,000. I haven't determined my depreciable amount, then I can get my depreciation for the year, depreciation for this year, which is simply going to be my depreciable amount divided by the what? By the useful life. Divided by the useful life. And what's the useful life?
Small given. Okay,
What's the useful life?
like 500,
5,000
5,000 units.
5,000.
Okay, 5 million units, right?
Yes.
Okay. So since I'm expressing my figures in thousands already, so this can go for 5,000 units. So if I do 488 divided by 5,000 units, that will give me my amount per unit. That will give me amount per what?
Per
Unit.
unit.
So how many units did we produce in year one? We
Yeah,
produced 1,000 units in
1,000 units.
okay, 1,000. Then we then multiply that by 1,000. So whatever you get,
97,600. 600.
97,600. Okay, that being gotten, then my carrying amount would be my costs, which is 488,000 minus my accumulated depreciation, which is, no, what's my cost?
Because it's
My
578,
cost,
sir.
578,000 minus 97,600. So what's my carrying amount?
480,400.
480,400. So now I've gotten my depreciation in year one, Abi. Then I can insert it here. Is that correct?
Okay.
Hello, guys. Are we still in this war together?
Yes, we are with you, sir.
That's together.
Please don't forget our formation. So in year two, I haven't determined this. Year two should have been seamless because in year two, I will just have done, okay, my depreciation for the year. I would simply just do 88,000, which is my depreciable amount, divided by 5,000, Abi, multiplied by what's the unit produced in year two?
1,200.
Multiplied by 1,200. Then that will have given me my depreciation in year two. But a lot of things happen in year two. A lot of things changed actually. Because they said at the beginning of year two, which is September 1st, 2016, is the beginning of year two. You need to know that because the end of year one is August. Therefore, given September 1st, that means that's the beginning of year 2. They said this guy decided to upgrade the machine by adding a new component that cost 300 million. As a result of the new upgrade, there was an increase in the remaining useful life to 8 million units on that date. Not only that, the residual value was also revised as well. Okay, fine, no problem. So the first challenge in front of us is that this 300,000 is a subsequent cost because it's a cost incurred after the asset is in use, after the asset is ready for use. When we have subsequent cost, the key question we need to answer is that this subsequent cost, are we going to capitalize it or expense it? I told you that we will capitalize it if the subsequent cost increases the productive capacity of the asset or if it increases the useful life of the asset. The examiner will tell you. The examiner told us that this cost, this upgrade, resulted in the increase in the useful life of the asset. So this cost would be capitalized. That's one. Two, the useful life increased to 8 million. To 8 million. So there is a change in useful life and there was a change in residual value as well. So for that reason, a lot of things is going to change. Our depreciation will change for that year. So how do we determine our depreciation? So let's just get into it. Now, that means in year 2, this cannot be our depreciable amount again because there have been addition to cost and all of that. So I need to work out my depreciable amount in this year. And to get my depreciable amount, the easiest way for you is to start from the last known value. You know, this 480, 400 is like the last value of that asset. The remaining value that you're supposed to depreciate. It's like this 480, 400 was the last known depreciable amount because after removing the last year depreciation, we were left to this. So anytime there is this type of revisions in residual value, in useful life, additions, you would usually work from the last figure going forward. You work from the last figure going forward. So my carrying amount first is my last carrying amount. It's like my carrying amount brought forward, 480, 400. The subsequent costs. How much was the subsequent cost?
800.
No,
I mean, sorry, 8,000.
no. Thousand.
I thought
About
300 million. 300 million.
Okay, sorry, 300 million.
yeah. So we have 480, 400. So this is our new, this should be our new depreciable amount. The amount we have not depreciated as of that date. However, remember, if you have residual value, it has to be removed. And we are told that our residual value has been revised to what?
114,000.
Yeah, that's correct. 114,000. It has been revised to 114,000. So how much do we have left?
Six 400.
It's a wicked figure. 66. Okay, so these are our new depreciable amounts. So I will replace that with this 666 400. Okay. Secondly, would this continue to be 5 million?
No,
No.
8,000.
Sir, 8,000.
To be 8,000 now. Okay. Fine. What about this one too? The year 2 production, will it continue to be 1, 2?
No,
Yes, sir.
Joy,
it
you
will
said
not.
it.
Who's-
What will it be, Joy?
So I think we are to split the 8,000 within the other years that are remaining.
Can you please clap for Joy, please? Michael, clap for Joy. Let me hear you. That's really fantastic. And that's very intelligent. So, because ordinarily in year 2, the remaining life should have been a reduced figure, right? It should have been a reduced figure, but they revised it like an increase in life. So this increase in life to 8,000. That means the annual production going forward, of course, they won't remain the same now. That means they have automatically increased. They would automatically increase. So the key question is, okay, by what amount? So that's easy, right? Easy in the sense that because the total units before now, if you look at the year 1, it was 5,000 units. And out of these 5,000 units, we already produced 1,000. That means the remaining useful life of the asset should ordinarily be 4,000, right? Should ordinarily be 4,000. Now, for it to increase to 8,000, we can rationally say that it has doubled. That means it doubled from 4,000 to 8,000. If this increase will have been something like 7,000, I would have needed some kind of calculator to get the increase. But the examiner will not be that wicked. So they ensure that it's doubled so that you will not spend so much doing arithmetics, right? So there was an increase in the total useful life by 100%, which goes to show that our productive capacity every year should increase by 100%. Yes. So this 1, 2 now becomes how much? Before it doubles. It will double. It becomes 2, 4 in year 2. That of year 3 also will
Sorry,
double.
sir.
Yes? Yeah, me too.
This is actually confusing. The number of units produced by each year does not accumulate the 5,000 before when we calculated it.
That means, and I made that very clear right from the beginning. That was the first thing I mentioned,
Maybe,
that
yes,
it
you
means
said maybe
that
there will be an additional year. Probably there's an additional year.
exactly. So that solves it.
But I don't know if you can explain again. This is actually confusing. I don't know.
I mean, I will basically will be saying what I've said before. Don't you think you should tell me what you understand?
Okay, continue.
Okay. So since the useful life moved from 4,000 to 8,000, it simply means that the remaining useful life has doubled, which means that our productive capacity every year, so that it can add up to that 8,000. Because by the time we double each of these, we double this, because ordinarily the remaining should be 4,000 plus the extra 600 that we did not include before. It should add up to 4,000. If you want it to add up to 8,000, now we need to double each of them. Okay, so can you please give me this figure? Joy, what do we have?
199, 920.
199,
920.
920. So what is our carrying amount? Again, just to make it simple for us, we can work from where should we work from? From these last known costs, from this one. Let's see, you can do it in 2 ways. So ordinarily, your carrying amount should be cost minus accumulated depreciation. So, or a question like this, you can just work from the previous carrying amount. Ordinarily, the previous carrying amount was 480,400 from last year. You will just remove depreciation of this year. But because of these additional costs, okay, that carrying amount becomes this 480,400. If you remove depreciation for that year, which is 199,920, what would be my carrying amount for this current year?
580, 480.
Sorry?
580, 480.
580,
480.
480. So every other one would be a little easier now. So depreciation for the year, what's my depreciable amount? It remains 66,400 divided by what? By the useful life.
1,000.
Multiply by what? What's the output for the third year? It was
That's
1,200.
1,800.
So we double it to make it 2,800. So what do we have?
233, 240.
233,240. So my carrying amount, I can work from last year's carrying amount, which is this 580, 480 minus 233, 240. How much would that give us?
Three, 4, 7.
347, 240.
240.
347,
240.
240.
240. This, let me not miss out my dates. This is August 2018. So let me deal with August 2019, which ordinarily should be the final year. So what's my depreciation for that year? 666,400 divided by the useful life, which is how much? 8,000
8,000.
multiply by, what's the unit for that year? 800,
1,600.
double it, 1,600. So what was our depreciation?
133, 280.
What did you call it?
133, 280.
133.
280.
Okay. So what's my carrying amount? So if I work from last year, that would be 347, 240 minus 133, 280. So what do we have?
213, 960.
213, 960.
960.
And that's the end of the year. Let me just do that extra year, just to exhaust all the units. The extra, because the units, like Bosse was asking, let me just do this. Even in the exam, don't bother doing this because you're not required. Just do, but this class. So let's do that 66,400 divided by 8,000. So what did we say it's ordinarily, the remaining unit was, we said it was 600, Abby?
600. Yes, sir.
So that also will double in the final
Yeah, we
year.
want to.
Add up to, yeah. So how much do we have?
99,960.
960.
99,960. So what will be the carrying amount? Working from the previous year, that will be 213,960 minus 99,960. So what would that give us?
144,000. 114,000. 114,000.
114,000. Okay. But ordinarily, why is the carrying amount? Because this is like the end of the life, since it has exhausted the whole of its productive capacity. if you add those units from when we started the doubling, if you add this 2.4 plus 2.8 plus 1.6 plus 1.2, it should give you 8,000. So which goes to show that at this 2020, the asset should have exhausted its entire useful life. So, but that's the carrying amount should be zero. Is it that we are not correct or what? Why is the carrying amount not zero?
Sir, it's not zero because we are told that the residual value will be 114
Oh,
million.
fantastic, Joseph. Fantastic. That's brilliant from you, Joseph. So, because we're told in the question that the residual value is now 114. So we don't expect the carrying amount to be 114 at the end of its useful life. We don't expect the carrying amount to be zero at the end of its useful life. We expect it to be 114. So which is why this is not giving us zero, it's giving us 114. Good one, Joseph. Okay, so that's the end of this question. So which is why I take my time teaching you principles. Because look at, it was so easy to answer these other ones. It was so easy for us to answer these other ones. But when we got to this one, 3 marks, let's say this one was relatively easy, but look at the effort we will have put. This one too, we could not even finish this one until we do the next one. Look at the effort we need to put to get all these 5 marks. Compare it with the effort you need to put to this that gives you 3 marks, or this that gives you. So, I mean, in financial reporting, yes, all these calculations are okay, but all these explanation principles, don't joke with them. They can easily make you get pass mark in the exam. They can easily make you get pass marks. Okay. Let's slot in all our depreciation in year 2. In 2018, what was the depreciation? 233,400. In year 4, what was the depreciation? 133,280. Okay, so that's all for this question. That's all for this question. Do you have any addition? Or we move to the next question. Okay, Femi, please read this next question for us.
Oh, okay, sir. That's a property was purchased. Is that one?
Yes, please.
Okay. A property was purchased on 1st of January 2000 for 2 million. That's the estimated depreciable amount, 1 million minus useful economic life of 50 years. Annual depreciation of 20,000 naira was charged from 2000 to 2004, inclusive and on 1st of January 2005, the carrying value of the property was 1.9 million. The property was revalued to 2.8 million on 1st January 2005. Estimated depreciation amount to 1.3 million, 1.35 million minus the estimated useful economic life was unchanged. Show the treatment of the revaluation surplus and compute the revised annual depreciation charge. Thank you, sir.
Okay, thank you, Femi. So you can mute now. Okay, so this question wants us to show the treatment of the revaluation surplus, and also we should compute a revised annual depreciation charge. So what are the variables given to us here? So we have an asset that was purchased in 2000, an asset that was purchased in 2000 for 2 million. This thing they put in brackets is just giving us further details about this asset at this date, telling us that at this date, the depreciable amount of these assets is 1 million, and the useful life of these assets is 50 years. Okay, if I may ask you, please, class, if the depreciable amount is 1 million and the cost is 2 million, so how much is the residual value? Anybody?
It's 1
Thank you
million,
very
sir.
much. Thank you. 1 million. Okay, good. So they said annual depreciation charge is 20,000. Okay, from 2000 to 2004. That's for 5 years. 2000, 2001, 2000, 2000. Okay, 5 years. How did they get this 20,000? Anybody? How did they get this 20,000? That will simply be the depreciable amount divided by the useful life. So if you do 1 million divided by 50 years, that's how they will have derived this 20,000. If you punch it on your calculator. Okay. The examiner went on and said that on 4th January 2005, the carrying value of this asset is 1.9 million. And how did they get this 1.9 million? Since the depreciation per annum is 20,000 and is from 2000 to 2004, that's 5 years depreciation. That means the accumulated depreciation is 1 million, no, 100,000. If you take that away from 2 million, that's how the examiner got this 1.9 million, which is the carrying amount at the beginning of 2005, which is the same thing as the end of 2004. Okay. We're now told that the property was revalued to 2.8 million on that same date. Okay. And on that same date, the depreciable amount of the asset is 1.35 million and the useful life remain unchanged. So first, how do you get the, you see, on 1st of January 2005, we need to compute the revaluation surplus or deficit. And we get that by comparing the carrying amount of the asset, which the examiner told us is 1.9 million, with the revalued amount of the assets. And what's the revalued amount? 2.8 million.
2.8.
So this is obviously a revaluation surplus
Yes.
of how much?
900,000.
900,000.
900,000.
Of 900,000. Okay. Or to make it clear to some of you, let me express it in thousand. Okay. So that's the evaluation surplus. And now what you have learned about evaluation surplus is that evaluation surplus should be recognized to where?
OCI.
OCI.
Other comprehensive.
Recognized to OCI. Okay. And I told you that even though you don't do that in the exam, since I'm just teaching you everything now. So I told you that you can do a revaluation transfer per annum. You can do a evaluation surplus transfer. You know, yesterday I was teaching you that when you sell an asset, that is when this revaluation surplus, you will earn it. You will transfer it to retain earnings. But I was then arguing that methodology that, okay, why are you waiting till you sell the asset before you start realizing that surplus? Can't we be realizing it gradually every year by saying that we'll say revaluation surplus divided by the remaining useful life? So that is revaluation surplus. What's the remaining useful life on these assets? The original is 50. It has used 5 years. So as at January 2005, that will be 45 years. So what would have been the revaluation transfer per annum? Is that not 20? Is it 20?
20, yes, sir.
Okay, so this is optional. Don't do it in the exam because the examiner didn't ask you to do it. If they want you to do this transfer, they will really ask you to do it. Okay. So in that case now, if something like this happens, it means that at the end of the year, the balance in your evaluation surplus will not be 900 anymore. Do you know what it will be? 880.
900 minus 20.
It will become 880. Because it means that you are going to take 20 from that surplus and go and put it in your retained earnings. That, okay, yes, we have earned this portion. And that's how you do every year, till the end of the useful life of the asset. But let me just put it there. Let me note it. This is optional. Only do this when required by the examiner. Okay, Femi, go ahead and ask a question, please.
Okay, sir. So assuming now we started taking the revaluation surplus,
Okay.
this fraction, and be taking it to our retained earning every year. Now,
Yes.
maybe in the third year or so, we made a loss or
Again.
valuation loss
Yeah.
than that 900,000. But we have started taking part of it to retain earnings. So how are we going to treat it?
The same way you have been tweeting, whatever is remaining, let's say you make a loss of, let's say, 920, and you have taken like 60 away from the existing 900, meaning it's remaining like 840.
Okay.
So that loss you make, first, you take 840 to OCI to net off the balance of the of the surplus. Whatever excess goes to P&L. It's the same, nothing complex.
Okay, so we'll not worry about the one that we have taken to retain earning
No,
again.
you will not worry
Okay.
about it.
Okay, sir.
Yeah.
Is
So,
it doing a faithful representation?
yes, but sir, it will be it will be a faithful representation because you know that those ones you have taken to retain earnings is as good as, okay, we are saying that those portion we have earned them, and it's just there in our retained earnings, and it's not like we want to distribute it or what have you. And again, doing this, we are just complying with Accrual convention. Accrual really wants us to recognize things annually, every year. Okay, though, which is why the standard said that it is actually optional. It's optional, that don't do it. It's not compulsory. Even in your exam, don't even do it. You only do it when the examiner requires you to do it. Okay, so let's move on. So what would then be our annual depreciation? What will be the revised annual depreciation? It will just be the depreciable amount divided by the So what's our depreciable amount? 1,350. See, 1,350 divided by remaining useful life, which is 45 years. So how much do we have?
Let's see.
30.
Have 30. Okay, we have 30. Okay, and that's the end of this question. That is the end of this question. So the second question says the property referred to in example 1, that is this property that we solved in this question. He said the property referred to in example 1 was revalued in 31st December 2006 He now said that its fair value had fallen to 1.5 million. Compute the revaluation loss and state how it should be treated in the financial statements. So, how do we do this? How do we compute the revaluation loss as at this date, as at 31st December? So, you see, one of the easiest things you would do in the exam is computation of revaluation loss or gain. Because when you are determining evaluation loss or gain, you are always determining it at the date of that evaluation. In this case, is 31st December 2006. That's when we want to do the determination of revaluation surplus or deficits. So, and to determine the revaluation surplus or deficits, you will compare the carrying amount of the assets with the fair value of that asset. They will always give you the fair value, and they have given us the value of the asset as 1.5 million. Let me write it like this. That means, let me put this there. So what's the carrying amount? How do we get the carrying amount? So let's work from here. This is 2006. If you want to work from 2006, what was the last carrying amount that we know? Since the annual depreciation from 2005 was 30, 30, 30, 30, 30. So what was the carrying amount here? We need to compute the carrying amount here. The carrying amount here would be the costs. You know that they revalue these assets here. So which means that the cost was now 2.8 minus the
Minus 60.
depreciation. No, the depreciation for that year, for that particular, I just want to get the carrying amount for 2005 first, which is 30. Okay. So how much would that give us? That would be two what?
277.
2770. Okay, so if we have that, if that's 2770 in 2005, so that means in 2006, they will have charged how much again? Another 30, right? Since
Yes,
it's
sir.
1,000 per annum. So what will be our carrying amount now?
2740.
2740. If that is 2740, what do we have as this is a revaluation deficit? How much is that?
1240.
240.
Okay, so I just want to get back to something. This is a very it's a very technical question, right? If you understand this, you will understand most questions in your ICANN exam. So first, from this question, we were able to determine revaluation surplus or loss or deficit by doing the carrying amount. This was given to us in the question, compared with the revalued amount, which was also given to us in the question. So we saw that that was a loss, and we said that was a surplus, and we said that surplus will go to OCI. Now, this surplus, I said optionally you could decide to be transferring that surplus to retained earnings every year by doing this. That 900 divided by 45 years. But I said this is optional. And I said, don't do it unless the examiner asks you to do it. So we said, don't do it unless the examiner specifically asks you to do it. Now, the depreciation going forward, depreciation is always depreciable amount divided by the life. The examiner gave us the depreciable amount as 1350 divided by the useful life. So that means over the remaining 45 years, our depreciation will be 30 years every year. Therefore, our carrying amount is 2.8 minus 30. You see, I've seen students compute carrying amount as depreciable amount minus 30. I've seen students do that. They will say, is this one that we are depreciating? It should be this divided minus the depreciation for that year. No. Carrying amount is cost minus the depreciation. So in this case, the cost for that year, the value of the asset as at that year is the new value, which is the revalued amount. So it's 2.8, which is now the fair value, minus the depreciation for that year, which gives me this. The examiner now say going forward, at the end of the next year, which is 2006, that the value of the asset has fallen, I should calculate loss again. Fine. To calculate that loss as at this date now, we need to also compare carrying amount minus fair value. Now, since we know that depreciation is 30K per annum going forward, that means in 2006, depreciation will also be 30. So your carrying amount, working from the last carrying amount, is just this 2770 minus depreciation for that current year of 2006. And that gives us this. And given the fair value of 1.5, our evaluation deficit is this. So I don't know if Abosede is still around in this class. I need you to tell me, how do you treat this 1240? Where does it go to? Where does it go to?
The evaluation
It's
deficit go to
supposed
the
to go
P&L
to P
account.
and L.
Joy, don't say it. I want Abosede to say it first.
Yes, it goes to the P or L account because it's a loss.
It will go to the POL account because it's a loss. Okay.
I
And I
think,
think that was what Joy was saying. Okay, Femi, go ahead, please.
okay, I think we are supposed to net it off from the initial surplus. Then if we still have a more loss, then we cannot take it to P&L.
Thank you very much, Femi. Thank you very, very much. So you see, because there was a previous loss, so a portion of this evaluation deficit will go to OCI. And how much was the previous surplus? 900. That means 900 will go to OCI. The remaining revaluation deficits, the balance can then go to its P&L. And what's the balance? That should be around 340, if I'm correct.
340.
340. Thank you very much, Femi. I mean, that's the benefit of reading questions in the exam. You tend to follow closely. Okay. If you want to be reading, you need to find a way to settle Femi so that I
Yes,
can
sir.
hand it over.
Hello, sir.
Yes, Mr. Latif.
What's the valuation deficit to CI 900?
Mm-hmm.
Okay. Okay, I get it.
All right. So that's this one. So if I may ask you, if I may ask you, who can tell me what would the carrying amount? This is not part of the question. I'm just creating a question myself. What would be the carrying amount following up from this last one? The carrying amount of these assets at the end of 2007, at 31st December 2007.
To be 15.
That's not
That'll be 1470.
1470. Okay. You tried. You tried 1470, which is 15 minus the 30 that's the current year depreciation, Abi. But unfortunately, depreciation will change from next year since we had revalued the asset because this 30 that we computed from here will not work again. This 1350 or 45 will not work again. Since we had revalued, we need to depreciate going forward from that date. So since the new value is now 15, so that means our new depreciation would be the new value divided by the remaining years. That would be around 43 years because it was 45 in 2005 and this is 27, so 2007. So whatever you get here, your carrying amount will now be that's fair value 15 minus whatever depreciation you compute up there. So that's how that would work. So I just said I should bring that up. Okay, you will see a lot of that. Let's continue solving our questions. We still have like 1 hour. Okay. Femi, please read this question one to us.
Okay, sir. An entity purchased an asset on 1st of January 2006 for 10 million. The asset has a useful life of 10 years and uses the straight line method of depreciation. On 1st of January 2009, the asset's useful life is revised to add a further 3 years to it. The asset has no residual value. The depreciation charge for the year to 31st December 2009 should be A, 700,000, B, 1 million, C, 769 to 30,000, then D, 538,461,000.
I don't think I should solve this question. I've solved many questions for you like this, where they will say they change useful life and all of that. So let me put it here, assignments, so that when I share this, you know that you're supposed to do it. And please do it as fast as possible. You don't want to be carrying these things forward. You get lost because it becomes plenty. So Michael, you are raising up your hand, please.
Yes, sir.
Okay.
Sir, for the revaluation surplus, if we are to be closing it on a yearly basis to retain earnings,
Yeah.
and then when we incur this particular revaluation deficit, so
Yeah.
at what amount are we going to have? Because there now we are still having 9,900.
Yeah, it
So
will
will
have
it
been
still be that 900 or to less?
no,
Sir?
it will be the balance. It will be the balance. It will not be 900 anymore because we will have taken like
Okay,
60
so it
away
will
from.
be the balance.
Yes, to be the balance.
Okay.
Yes. Okay. Yeah, good question.
All right.
Yeah.
Thank you.
So I gave you this as assignment because yes, I've solved similar questions. So solve it so that when you solve it, you can share your solution to the group. So don't make that our group boring. I can see some of you are creating study group. Now that's a very brilliant idea. So don't make our group to be boring. I don't mind. You have your solution, put it on the group, let others to debate it. Then ultimately, I will say what the answer is so that people can learn. I mean, whenever I give you assignment like that, like this, let's discuss it on the group. Like, okay, this is what I got. What did you guys get? So that will encourage other people also to learn so that everybody would pass. Okay, so Femi, let's go
Sorry,
to
sir.
question two.
Sorry, good evening, sir. I have a
Hi.
question regarding here.
Okay. Okay.
Yeah,
Yeah, I'm with you.
regarding
Go
the
ahead.
revaluation surplus for that December 2006. Yes.
Okay.
So I wanted to ask why do we this 30 this 30,000, let me just say 30. Why did you
Okay.
not, like, because of it's 45, why did you not reduce to 44? Why do we keep using the 45 years as the really useful life for December 2006? Because this was January 1st, 2005, and the question was talking about December 2006. So I got
Okay.
confused when you did the one for 2007.
Oh, okay. Yeah. So that's a
Question.
very good question. And that's a very good question. So when we do something like this, the whole idea is that we want to depreciate over 45 years. And meaning we are spreading this 1,350 over 35 years. So the way we do depreciation, like, so in year two, let's say this is year one. In year two, it's still the same 30, it's still the same 1,350 over 45 years. Year two, year three, year four, like that. So it's the same amount. So where that would change, okay, where we usually do over the remaining useful life is where probably when there is um a revised useful life, or where there is a revised useful life, or where there is a change in residual value. So that is the scenario where we will find, okay, what's the last value that we know? What's the previous value divided by the remaining useful life? Otherwise, when you are using a straight line method of depreciation, is always equal amount of depreciation every year. So every year, you will not say, okay, you have done 1,350 divided by 45 in year one. In year two, we'll now do 1,350 divided by 44. No, that's not how it works. It's the same amount of depreciation every year. And depreciation using straight line method is cost minus residual value divided by useful life. So that cost is constant. It doesn't change. The useful life does not change. So the same amount every year. That's how we can achieve the same amount every year. If you do it the way you have said, we're not achieve the same amount every year. So that's how that works. It's only when
Okay,
you
sir.
value an asset, that's when you now do all upon the remaining useful life. Like the one I solved for you when I asked you for 2007 or
Okay.
thereabouts. Yeah.
Thank you,
Good.
sir.
Yeah, good question. Okay. Femi, let's go to question two, please.
Question 2. IAS 16 require a valuation surplus resulting from initial revaluation of PPE to be treated in one of the following ways. A. Credited to long-term provision and added to the PPE. B. Released to the income statement over the life of the PPE. C. Debited to the class of PPE that is being revalued and credited to equity. D. Credited to equity.
What's the answer here now? How do we treat revaluation surplus on the initial evaluation of PPE?
To
Here's the answer now. C.
credited.
Debited to PPE that is being revalued and credited to equity. Of course, before you get to equity, you credit OCI. Then OCI items becomes a reserve in equity. So the answer is C. Okay, let's go to question 3.
An entity has a policy of revaluing its PPE. An asset costs 15 million on 1st of January 2008, has a useful life of 15 years, and is depreciated on a straight line basis to a zero residual value. The value of the asset as at 31st of December 2008 was 14.5 million. At 31st December 2009, the market value of the asset was 12.5 million. The accounting entry at 31st December 2009 would be, hey,
Okay, no problem.
okay,
Don't bother reading this. Right. So let me just solve this. And again, I want to mention that, you see, all this practice question here, I mean, wherever I stop today, whatever is left, I would ask you to practice them because it should be repetitive for me. If you can practice and know every question I've solved for you in this topic, I'm guaranteeing you, there is no question I can bring in PPE that you will not be able to tackle, because these questions have actually taken care of everything, every area that needs to be covered in terms of depreciation and evaluation, as the case may be. Okay, so looking at this question now, this is another dynamic. So they said this entity has a policy of revaluing its PPE. So they use a evaluation model. So the cost of the PPE is 15 million on 4th January 2008. It has a useful life of 15 years and is depreciated on a straight line basis to a zero residual value, right? So we're now told that the value of the asset as at 2008, meaning as at the end of the year, is now 14.5 million. And as at the end of the next year, the market value is now 12.5 million. So when I asked about the accounting entry in 2009, okay, fine. So I mean, let me move because this question has a lot to it. From 2008, where they give me a cost of 15 million, then useful life 15 years, straight line method of depreciation, nil residual value. I was told that they revalue the asset. They said the value of the assets is now 14.5 million at the end of that year. So there was a revaluation of that asset. So I would need to get revaluation surplus or deficit as at the date of revaluation. So I will need to do a determination of revaluation surplus or what? Or deficits. And how do I do that? I simply compare carrying amount with the fair value. So I was told the fair value is 14.5 million. But what is the carrying amount? Of course, carrying amount is simply cost minus depreciation, right? So what's my cost? Let me just work it out. My cost is 15 million for that year. What's my depreciation for that year? It's simply cost divided by useful life, which is 15 years. So that gives me how much? 1,000.
1 million.
1 million. If I subtract this, I
14,000.
get how much?
14,000.
And
1,000.
so is this a surplus or deficit?
It's a surplus.
A
Surplus.
surplus of how much?
500.
500. So I have a revaluation surplus
Surplus.
of 500. So that's in 2008 too. Now let's move on to 2009. Because they said in 2009, there was another revaluation. They said the market value is now 12.5. So that means as at 31st December 2009, I'll also do a determination of revaluation surplus or deficits. And to do that, I'll simply compare my carrying amount with my revalued amount, which I can simply call fair value. And what's my revalued amount as of 2009? That's 12.5 million. What's my carrying amount as of 2009? That would be my costs minus my
Depreciation.
depreciation. So what's my cost? What's the value of the asset as at this date?
14.5.
14,500.
Thank you very much, because they revalued the asset in the previous year, so it's now 14.5. So that means the depreciation will be how much?
1,000.
Look at what Joy said now. She said 1,000. And there was a lady that asked the question the other time that why did we continue to use equal amount of depreciation? I said it's because it's straight line, it gives you equal amount. Unless there is a revaluation of that asset. If there is a revaluation of that asset, that's a scenario where we can do what she was saying, where we will say the new value divided by the remaining useful life. And that's this case we're having here. They revalue these assets. So this 1,000 cannot fly anymore because if the cost is not 15,000 anymore, the cost is now this. So which is this 14.5. And now that years have passed, so it should be 14 years. So ordinarily, that means it's like the new value of 14.5 is what we now need to spread over the remaining years of 14. So if there was no evaluation going forward, now, that means whatever we get as depreciation, can you give me the figure here, please?
1,035 naira or
Okay.
36 naira.
Okay, let me say
Approximately.
36. Yeah. So that means this 1,036 now is what will be our annual depreciation for the remaining years. For the remaining years going forward. But if there is another evaluation again, it cannot be that, and it will now be the revalued amount divided by remaining years, depending on when that evaluation was done. So that's how it works. You need to be able to identify those gray areas, right? So how much is this giving us?
That's a loss of
No,
that's
what's the carrying amount?
okay.
14.
13,464.
Okay, so this is a loss. A loss of how much?
The loss of 500. That's 964.
Okay, a loss of 964. So how do we treat this 964?
Since you have surplus, initial surplus, we net it off.
100 before.
Then
So
we
we
take
net
the
it off.
balance
The
to
balance to save.
P&L.
POL,
Fantastic.
sorry.
Fantastic. You get it. So that means a portion of the deficits will go and will go to OCI. And that's 500. Abi?
Yes, sir.
Mhm.
The remaining deficits and then go to where?
So P&L
Yeah.
And how much is that?
464.
464.
That's correct. That's absolutely correct. And based on this option, give us what will be the answer? Option 104, yes. Depreciation for the year is 104. Our income statement fall in value by 0.5 to income statement. So how much are we taking to POL? 0.5. Is it 0.5? And revaluation reserve 464. Income statement fall in value. Oh, okay. Fall in value of 0.5 charged to revaluation reserve. Okay, yes. 500 to revaluation reserve and 0.46 to income statement. Okay, yeah, 0.46 to income statement. So the answer is this A for this question, but I'm not really bothered about the options, but be able to do this in the exam. Femi, let's go to question 4.
Question 4. On 1st March 2000, Yuka Co. acquired a machine from Plant Co. under the following terms. List price of machine 82,000, import duty 15, delivery fee 2,050 naira, installation cost 95, pre-production testing cost 449, purchase of 5 years maintenance contract, that's 7,000. In addition to the above information, Yukaco was granted a trade discount of 10% on the initial list price of the machine and a settlement discount of 5% if payment was received within 1 month of purchase. Yukaco paid for the machine on 25th March 2000. You are required calculate the machine cost for the year ended 28th February 2001. Thank you, sir.
Okay, I won't solve this question. I'm going to give you as assignments, be a repetition for me. And that applies to this also. I already solved something even much more difficult than this, so I will leave that to you. So can you please read question 6?
Question 6. On 1st March 2002, Yukaco purchased an upgrade package from Plantco at a cost of 18,000 naira for the machine to originally purchase in 2000. The upgrade work took a total of 2 days where new components were added to the machine. Yuka agreed to purchase the upgrade package as the new component would lead to a reduction in production time per unit of 15%. This will enable Yukaco to increase production without the need to purchase a new machine. You are required. Explain whether the additional expenditure should be capitalized as part of PPE or expense to the statement of profit or loss for the year ended 28th of February 2003.
Okay, I will give you this one too as assignments.
Okay.
Because I don't want to say the answer, and I just want you guys to think. I've already talked about this already. So it's similar to what we have done before.
Question 7.
Don't bother reading this. I've seen it. Another assignment. Something we have solved. They change useful life, they change residual value. So this question 8 also. So it's something we have solved. I taught you this. When we have different, and I said I have different components with different useful life. I told you that you charge the position. So let me not tell you the answer. Let me just see what you come out, what you can actually come up with. So let's go to question 9 now.
Question 9.
Question, let me see.
Okay. Question 9. A company purchased.
Don't read it.
Okay.
Okay, let me do this. And the reason I'm doing it is because I just want to show you journal entry again. I've actually shown you this one before, but let me just show you one more time. Yeah, read on, please.
A company purchased a building on 1st of April 2001 for 100,000 naira. The asset had a useful life at that date of 40 years. On 1st April 2003, the company revalued the building to its fair value of 1,200. Require calculate the revaluation gain and prepare the journal entry to the account for the revaluation.
Okay, so let me just show you. Every one of you should be able to do this by now. Let me just show you. So they bought the building in April 2001. The useful life is 40 years. And on April 2003, they revalued the building. They now asked to calculate evaluation gain. So I told you that on the date of evaluation, I mean, whenever there's a evaluation, just sort out the evaluation first. On the date of evaluation, you will do a determination of evaluation surplus or deficit. And how do you get our evaluation surplus or deficit? By comparing the carrying amount with the what? With the fair value. And of course, they always give you the fair value very cheaply, which was 120. And what is the carrying amount? The carrying amount is simply the cost. The cost is 100,000 divided minus the depreciation. And the depreciation will be 100,000 divided by the useful life of 40 years. So if you do 100,000 divided by 40, what do you have?
22,000. 25,000.
5.
How much?
2,500.
2,500.
2,500. So if you do these maths, what do we have?
We have 97,500.
So this will give us a revaluation surplus of how much? This should be 22,500.
22,500.
Okay. So the examiner asks you for the journal entries. So the journal entry will simply be, like I taught you before, whenever there is a revaluation, the first thing you need to think of is your asset account. In this case, the building account. Let's say this is debit and the other leg is credit. Since the building account is going up from 100 to 120, don't make the mistake of debiting the assets with 22,500. That is absolutely wrong. I already told you. That would make the assets go beyond this 120. We want the asset account to be at 120. That means your asset is increasing only by 20. So you debit 20. Then you deal with your revaluation surplus. That goes to where? OCI. Where did that? Then that 22,000. Then you will then see that your account is not balancing. And that's simply because you need to nil off the accumulated depreciation. This 25, which obviously will have been a debit account before, but you need to nil it off, you need to debit it. So, and that's that 25. You will see that your debit now will equal your credit. Your debit will equal your credit. Okay? I've just revised this with you again. Let me revise one more with you. Let me see a difficult one I can revise with you. I'm going to give you these as assignments. Okay, let me revise this one with you. Can you read question 11, please?
Okay, sir. Question 11.
Okay.
A company revalued its property on 1st of April 2001 to 20 million, which is 8 million of which related to land. The property originally cost 10 million, 2 million of which related to land 10 years ago. The original useful life of 40 years for the building is unchanged. The company policy is to make a transfer to retain earning in respect of excess depreciation. You are now required to prepare any necessary journal entries to account for this property during the year 31st March 2002. Then number B, prepare extract from the following financial statement for the year ended 31st of March 2002. One.
Okay, no problem. Don't worry. Thank you. So let's solve this one similar to what we have done before. So this company revalued this property on 1st of April 2001 to 20 million. They said 8 million of which related to land. They said the property originally cost 10 million, 2 million of which related to land 10 years ago. The original useful life of the asset is 40 years, for which for the building is unchanged. The company policy is to make a transfer to retained earnings in respect of excess depreciation. Okay, good. So the first thing I really need to sort out is that the fact that there was a revaluation on 1st of April, which is like the beginning of the year, because from this extract, they asked me to prepare and all of that. They're asking me to prepare it as on March that year, which is like the end of the year. So that means on 1st April 2001, which is beginning of the year, I will need to do a determination of revaluation surplus or deficits. And to do that, like I've always told you, I will not change my approach. You simply compare the carrying amount with the fair value. So let me say this is thousands. They will have given me the fair value as at that date. So they revalue the asset to how much? To 20 million. So the fair value is 20 million. What's the fair value of this asset? What's the cost of this asset? The cost of this asset, they said the property
Originally
originally
10
cost 10
million.
million. So that means the cost is 10 million. What's the accumulated depreciation on this asset? So apparently they bought this asset 10 years ago. So how do I depreciate? First, I need to get my depreciation per annum. I can't do 10 million divided by, because the original useful life is 40. I can't do 10 million divided by 40. That would be wrong because this 10 million includes land and we don't depreciate land. Or do we?
No.
No.
We don't. So why don't we depreciate land? Why don't we depreciate land?
Because land doesn't depreciate.
No, that's
Because
absolutely
it's natural assets.
that's absolutely wrong. That's absolutely when who taught you that? When did I mention natural asset in this class? Which one mentioned that? Because land has an unlimited useful life. That's
Wow.
why. Not because land appreciates. Shey, building don't appreciate. And it's, I mean, with the inflation happening in Nigeria now, there no company should depreciate their asset again now. I've told you that depreciation is not loss in value. Depreciation, that was the beginning thing. That means your mind is too fixated on the old knowledge you have. The reason we don't depreciate land is because land has an unlimited useful life. One of the characteristics of a
Same as
depreciable,
building.
that's one of the characteristics of a depreciable asset. It must have a limited useful life. So
What about
because
building?
land
What
has
about building?
we depreciate building now. Building we depreciate, it has a limited useful life. Anything that has an unlimited useful life is not depreciable. Because there's, I mean, how do you want to allocate it? Look at the definition of depreciation I gave you. The depreciation is the
Thematic
systematic
allocation.
allocation of the cost or depreciable amount of an asset over its useful life. So that means anything that does not have a useful life, there's no way to allocate that cost. So we don't depreciate it. So because of that, our depreciation would only be on the building. So this 2 million included in the property, we would exclude it. So we would only depreciate the building. So what is 8,000 divided by 40? That should be around 200 or so. How much is it? Am I correct? Anybody?
200.
Yeah,
200.
correct, sir.
Okay. So I have a evaluation surplus of how much? Of how much?
10,200.
Okay. I saw somebody raised up his hand. Can you ask a question, please?
Okay, sir. Based on the land we are discussing, what about land that is used for agricultural purposes?
The standard, the standard didn't go into all of those unnecessary details. The reality is that land has an unlimited life. So whether one land is this or one land is that one is arguable. We don't want to, accountants don't want to engage in such arguments. Land has an unlimited useful life. Land is land, it's there forever. Whether for product, whether is not useful for what you want to use it for, is another thing entirely. It's useful for another person. It's there forever. Nobody can take it away. So, what was I saying? Okay, so we have gotten the revaluation surplus as at 2001. Okay, good. So, having determined that, then we can then go ahead and determine my depreciation at the end of the year. So, as at 31st March 2002, because this is the beginning of the year. Here's the beginning of the year where we'd revalued the assets. So as at the end of the year, 2002, my annual depreciation will be the revalued amounts, since they revalued the assets, it should be the revalued amount divided by the remaining
Useful life.
life. What was the revalued amount? It's 20, right? But
Yes.
can we use this entire 20? No, because 8 million of it related to what? Land. So there is only 12 million that is building that we are going to depreciate. So we are having 12 million divided by the remaining useful life. And what's the remaining useful life? So as at the end of this year,
That's
you know,
39.
the asset life is 40 years originally. And as
Okay.
at 2001, they are saying that we already bought the asset 10 years ago.
10 years ago. Okay.
So that means the remaining useful life of the asset is actually how many years? It's 30 years. So how much is our annual depreciation?
$400.
400.
400. So second thing is that they said is the company's policy to transfer retained earnings in respect of excess depreciation. If you remember, this is the revaluation reserve that we transfer to retained earnings. That's what they sometimes call excess depreciation. I will tell you why they call it excess depreciation. The way I've taught you to calculate it is this. I said excess depreciation. I said, is that revalued amounts divided by the what? Say revalued amount. If that revaluation surplus divided by the remaining
Useful life.
useful life. And the evaluation surplus we computed was how much? 10,200, right? Yes. So
Just like
10,200.
allocating it the way you explained it.
Exactly. Exactly. Divided by 30 years. So how much is that?
340.
340. 340. Okay. So having determined that means we are done with everything. We're just looking at what is left to do. So that's everything. So the examiner asked you for journal entries. So if I want to pass the journal entries one by one, if I want to pass the journal entries one by one, first, the evaluation surplus, of 10,200. How do I pass that journal entry? First, my asset account, which is the property. That would be, let's say this is debits and this is credit. So the property that used to be 10, now we want it to be 20 because that's the new value of this asset. We want it to be 20. So we debit 10 because we are going to increase it by 20 to go up from 10 to 20. That's one. Number two, the revaluation surplus. So let me just make this one 10,000 just to make sense. The revaluation surplus goes to OCI as credits. And how much is it? It's 10,200. And thirdly, the accumulated depreciation on that asset till that date of revaluation, which is this 200, needs to be eliminated. So we'll debit it. So accumulated depreciation 200. So this balances out debits, credits. The second is this depreciation, the subsequent depreciation. With the depreciation, I will debit my depreciation to POL, which is 400. I will credit my accumulated what? Depreciation, which is 400 for my depreciation for the year. And thirdly, this is my excess depreciation. With my excess depreciation, I will debit my revaluation surplus of 340. I will credit my retained earnings with the same surplus. So these are all the journals. So you can do some narration. This one being revaluation surplus. This one being depreciation for the year. This one being transfer of excess depreciation, so that you know what those journals are meant for. So that's the journal. Secondly, we are asked to prepare some extracts of P&L for the year. So my statement of profit or loss for the year ended. First, my depreciation for the year will go to POL. That's the only thing that goes to POL here. Then, what again? I was asked to prepare my statement of financial position. The property. How much is the value of the property now? It's 20 at the beginning of the year minus depreciation for the year, which is 400. So 20 minus 400. That's how much? 96. So my statement of changes in equity, the only equity item that is relevant here is my revaluation reserve in the retained earnings. So my revaluation reserve for the year or my evaluation surplus from the year that was coming from OCI, how much did we compute? We computed 10,200. I made a mistake here. I'm just saying it, and nobody saw it.
I was waiting for you to finish because they said 10 years ago, sir. Oh,
Yeah. Instead of you waiting for me to finish, why didn't you wait to the end of the diet?
honestly, I saw it later when I was when you scroll down, but I wanted to ask if there's a reason why we didn't
Yeah,
that
yeah.
10.
It's supposed to be 2,000. It's supposed because accumulated depreciation is actually 10 years ago. Femi and Joy, what were you guys looking at? So this should be our surplus should actually be 12,000. Because I know that something was wrong, but I just left it. I know I was going to come back at it because when I knew that this excess depreciation was wrong, like I just know it. So this is supposed to be how much? Oh,
400.
okay, no problem. It's just very few corrections. This should be 12,000. This should be 2,000. 100. 100. This should be annual depreciation.
400.
400, sir.
100. Okay, this does not change. Okay, so this is 12,000. So, and they said there is excess depreciation. That's the transfer to retained earnings, meaning we are transferring that excess depreciation of 400 from year. We are transferring it to year in such a way that the balance here will be 11,600, while this is 400. Why this is 400. So that's the end of this question.